Good morning, students. Today we are going to read some real examples of demand and supply in the topic of determination of the market price in the subject of economics O levels. So concentrate yourself. Here we are going to start. The first example is non-market prices, holding down food prices during an emergency. In times of the severe shortages, for example, in times of the war, the government fixes a price at a level where the majority of the people can afford to buy daily necessities. Below the market forces equilibrium prices. So definitely in the time of the wars or in the times of the earthquake or floods, whatever the market price is, government normally fixes the market price below the original equilibrium price so that the people can afford the necessities of the life. However, fixing below the true market price can cause problems as producers will supply less and there will be excess demand as shown in the diagram below. People are willing and able to buy more than is being supplied, so there will be queues and waiting list. This might lead to introduction of some of the forms of the rationing. However, the main point is that the amounts consumers receive will be much less than what they would have liked and afford to buy at the price set by the government. And here is the graphical representation. In the times of the emergency, government normally fixes the market price below the original equilibrium price. For example, this is the original equilibrium price. So you can see equilibrium price is P and government fixes the price at P1. So this is the maximum price for the commodity in times of the emergency. So definitely the producers will supply less in the market. So this is the portion that is showing the excess demand or the shortages. The next example is offering farmers a guaranteed price higher than the free market price. So definitely when the farmers got a bumper crop, so there will be excess supply in the market, and because of the excess supply in the market, there will be downward pressure on the equilibrium price to restore at the lower new equilibrium price, and due to that the farmers will get loss and they will be discouraged to grow that commodity again in the next season. So due to this, the government normally fixes the price above than the market price. So here you can see in the European Union and in many other parts of the world, government guarantees minimum price for these certain agricultural products. These guaranteed prices are often higher than the prices the farmers would have received had they sold their products on the free market. The government will deal with the surplus by buying it from the farmers and storing it. This is demonstrated in the diagram that follows. So here is the graphical representation of this case. Here is, you can see the equilibrium price is P, but this is lower than the expected price of the farmers. So government fixes the price at the P1, that is higher than the equilibrium price or the market price, and government fixes the price at OP1. So this portion is the surplus that will be purchased by the government, and the government will store in there. Government will store that portion. The next example is the fixed supply. For example, World Cup final tickets of the football or the cricket or the hockey. So there is another example of the price fixing as shown in the diagram below. The Football Association fixes the price OP1 below the market price so that they are more affordable to regular fans. Supply is fixed at Q1. So because the number of the seats are fixed in this stadium, so supply is fixed. But the price that is set by the Football Association is below the market price to encourage the fans to come in the stadium and watch the match. So definitely look now what will happen. Okay, at this price, the quantity demanded OQ1 exceeds the tickets available. Quantity supplied at OQ. There is an unsatisfied demand. The Football Association tries to use some form of the rationing combined with affordable prices, which result in the number of the disappointed football fans. However, this can lead to black market sales. So this is the normal phenomena. So after some time, the persons who purchase the tickets, there are a lot more unsatisfied fans who could not buy the tickets. So there creates the black market in which the prices of the tickets are much higher than the original price. So this is the case now. Okay, look now. However, this can lead to black market sales whereby tickets are bought and sold underground at prices much higher than the official selling price. And this is the case. So look now, free market prices P. This is the free market price, but the Football Association has set the price at P1. So this is the quantity demanded at free market price, and this is the quantity demanded at the lower price that is fixed by the Football Association. So this is the portion that is blue, that is the shortage. Okay, the next thing that we are going to read is the taxes and the subsidies. So taxes is the main source of the income from which the governments finance their spending. There are two kinds of the taxes. Number one is the direct tax that is applied on the income and wealth, and the second is indirect tax that is applied on the goods and services. So definitely when the tax will be applied by the government on any one of the commodity, so definitely the cost of the production will be increased, and due to which the producers will be able to produce less and supply less in the market. So when there will be supply less in the market, definitely demand is still there. So excess demand will be there, and there will be upward pressure on the equilibrium price to restore as the new equilibrium price that will be set above the previous equilibrium price. So this will be the case when taxes will be applied. And on the other hand, when subsidies were be given, subsidies, because of the given subsidies, the cost of the production will be reduced. So cost of the production will be reduced. So it means suppliers will be able to produce more and supply more. So when supply will be more in the market, demand is still there, the same. So it means there is more supply or excess supply in the market. So there will be downward pressure on the equilibrium price to restore as the new equilibrium price that will be lower than the previous equilibrium price. So this will be the case of the taxes and subsidies. So this was the lecture, students. I hope so this will be much more easy and interesting for you to understand now. So read this lecture again, understand it, learn it, and make your notes. Thank you so much.